The most dangerous bank run of the modern era doesn't look anything like the photographs from 1930s America. No lines stretching around street corners, no panicked crowds demanding deposits, no newspapers warning that vaults have run dry. Today, according to analysts reviewing liquidity data, the real threat hides in silence. A slow, steady migration of nearly $17 trillion shifting away from traditional banks, drip by drip, day by day. And here's what nobody tells you. Modern financial crises often begin not with chaos, but with quiet decisions made at kitchen tables, office desks, and phone screens. Withdraw here, transfer there, redirect savings somewhere else. No shouting, no fear, just movement. This is where the pattern begins, and it connects directly to the viewer's financial present. Interest rates rising at the fastest pace in decades. Savings accounts paying a fraction of inflation. Households reconsidering where to store their money. Businesses tightening lines of credit. And beneath all of this, a tectonic shift unfolding. Deposits leaving the banks that rely on them to lend, operate, and survive. Analysts argue that the migration may not guarantee collapse, but it signals a structural stress echoing through the system. To fully grasp what's unfolding right now, we must anchor the story not in emotion, but in history. Because every financial era has contained a moment like this, a moment when people quietly questioned whether their institutions were as stable as they appeared. In 1907, a series of bad bets by trust companies triggered a panic that nearly brought down the American economy. When rumors spread, depositors rushed in person to withdraw their savings. The system snapped under the pressure until intervention from financiers temporarily stabilized the markets. In 1931, Austria's Kreditanstalt collapsed under losses it attempted to conceal. The failure triggered a chain reaction across Europe, deepening the global depression. In 2008, the modern liquidity freeze arrived. Banks didn't collapse from empty vaults. They collapsed from frozen credit channels. Everyone thought they were safe. They weren't. The danger wasn't what people saw, bank branches, loans, deposits. It was what they ignored, the system's dependence on liquidity flowing freely. And now, analysts suggest we are witnessing a quieter variant of the same pattern, a slow-motion bank run facilitated not by panic, but by yield differentials, digital transfers, DOS, and structural distrust. The modern version doesn't require fear. It requires math. Let me show you exactly how this begins. For most of the 2010s, interest rates hovered near zero. Banks had abundant deposits and savers had few alternatives. Money market funds paid little. Treasury yields were low. Leaving cash in a checking account felt harmless. But then the 2020s arrived, and inflation surged to levels not experienced in decades. To counter it, central banks raised interest rates again and again. Suddenly, safe instruments, treasury bills, money market funds, and high-yield savings products offered returns far higher than traditional banks. At first, the shift looked like a simple rotation. Investors chasing better returns, households adjusting savings strategies. Then the bill arrived. Deposit levels at many banks began falling. Liquidity ratios tightened. Loan growth slowed. Regional banks, which depend heavily on deposits, found themselves in a difficult position. Pay higher rates and damage profitability, or maintain low rates and watch deposits leave. Everyone thought the system would adapt easily. It didn't, because this wasn't a small shift. It was a structural migration of capital, a movement from low-interest institutions to high-yield alternatives. Analysts reviewing the Federal Reserve's data noted an accelerating divergence. Trillions flowing into money market funds, short-term government securities, and private liquidity vehicles designed to benefit from rate hikes. Meanwhile, traditional banks saw an erosion of deposits unlike anything in recent decades. Here's why this matters. In modern economies, banks don't need to lend huge sums to collapse. They only need to lose confidence, or liquidity. Liquidity is the blood of the system. When it drains, no amount of calm messaging can reverse the trend. This is the trap. This quiet migration puts pressure on lending, pressure on credit lines, pressure on small businesses that depend on banks rather than global markets, pressure on households that rely on stable credit conditions for mortgages, cars, education, and emergencies. When deposits leave, Banks must shrink or find alternative funding, and alternative funding is expensive. But the story goes deeper. To understand the emotional and financial chain reaction unfolding, we need to examine the behavior behind the numbers. For ordinary depositors, the shift wasn't driven by fear, it was driven by logic. Why keep savings in an account yielding 0.1% when money market funds pay several percentage points? Why leave cash in a checking account when short-term treasuries outperform inflation? The migration accelerated because it made sense. For businesses, the shift carried another motive: protection. Analysts observed that firms with large cash holdings began diversifying across institutions to avoid concentration risk. This diversification is healthy at the individual level but destabilizing at the institutional level. When capital spreads thin, banks reliant on concentrated deposits lose resilience. For wealthy clients, the shift reflected opportunity. Many moved capital into private credit funds, alternative liquidity pools, and direct treasury purchases, entities that provide yield outside the banking system entirely. At first, it looked manageable. Then, something subtle changed. Banks began tightening credit standards. Surveys indicated reductions in lending willingness. Small and mid-size institutions, those most affected by deposit flight, reassessed loan risk. The liquidity they lost couldn't easily be replaced. And analysts began warning that a credit slowdown could ripple through the economy in the same way deposit outflows rippled through the banks. Here's the mechanism. When deposits fall and credit tightens, spending and investment also slow. A feedback loop emerges, not panic, gravity. This pattern resembles earlier periods of silent strain. In 1974, inflation and rate shocks created liquidity pressure that few recognized until markets cracked. In 1990, credit contractions quietly reshaped the housing and commercial real estate landscape before the recession was widely acknowledged. In 2000, the dot-com unwind didn't break the banks directly. It broke the flow of capital feeding them. What's occurring now echoes those shifts, but with modern amplification. Transfers can occur instantly. Depositors can move money with a tap. Markets adjust in real time. And yield differentials, small at first, compound dramatically over months and years. Here's what nobody tells you. Modern bank runs don't look like disasters. They look like optimization. Savers reallocate capital rationally, without emotional panic. Yet the impact on banks is the same. Outflows. The danger isn't in dramatic withdrawals, it's in silent ones. And this raises the central question, the question Section 2 will finally answer. If a silent migration of 17 trillion is underway, what happens when the system hits its breaking point? Because analysts suggest we may be entering a phase where liquidity stress intersects with credit tightening, creating a structural fragility beneath the surface of financial markets. Not collapse, fragility, not panic, pressure. And the next stage of this story will reveal the scenarios that could unfold: an orderly rotation, a tightening spiral, or a genuine liquidity shock. Each one depends on forces now set in motion but not yet fully realized. But the real danger is not what investors see today. It's what they ignore, because the system looks stable until the moment it isn't. And right now, the migration continues. The trouble with silent crises is that they rarely feel like crises at all. They feel like trends, adjustments, rational decisions playing out across millions of accounts. Analysts describe this moment as a slow reallocation, a logical rotation, a natural consequence of higher rates. But here's the mechanism. When trillions move quietly out of banks and into alternative vehicles, the banking system's core function, lending, begins to tighten. A society built on credit begins to strain, and the gap between what people see and what's actually happening begins to widen. To understand the evolution of this silent bank run, we must follow the path of the migrating trillions. Money that once sat inert in checking and savings accounts now travels into money market funds, treasury bills, and short-term liquidity products. These alternatives are safer for individuals but more dangerous for banks. Banks use deposits as fuel. Remove the fuel and the engines sputter. Yet the system still appears stable. No televised collapses. No lines of panicked customers. No shuttered branches. The calm is deceptive. Analysts warn that modern financial risk is algorithmic, not emotional. Depositors don't have to fear banks for banks to suffer. They merely need better options. This is where the deeper shift emerges. As deposits drain, banks must decide how to replace them. Some raise deposit rates, reducing profitability. Others tap short-term wholesale funding, which is expensive and volatile. Others shrink their balance sheets, which means fewer loans. And fewer loans, multiplied across thousands of institutions, ripple into the real economy. Slower hiring, weaker investment, delayed expansions, tightened credit. Here's what nobody tells you. A silent bank run doesn't crash the system all at once. It thins it out, little by little, quarter by quarter. Conditions worsen before anyone notices. The next stage of the crisis is shaped by who adapts and who breaks. Large banks with diversified funding sources can withstand substantial outflows. They attract deposits even during stress. Money flows toward perceived safety. But smaller and mid-sized banks, those more dependent on local deposits, face a harsher reality. Their cost of funding rises rapidly. Their lending power shrinks. Their customers increasingly view alternatives as preferable. And analysts fear that if this pattern applies widely enough, regional lending ecosystems could weaken dramatically. This creates a disparity. Strong institutions grow stronger as weaker ones struggle to maintain equilibrium. Lending centralizes. Credit consolidates. This is not collapse, it is concentration. And concentration creates both stability and fragility. Stability for those at the top, fragility for everyone else. Microhook number 1. At first, it looked like a normal rotation. Then, the consequences multiplied. To see how this mechanism evolves, consider the parallels. In 1994, rapid interest rate hikes created unexpected stress across banks holding long-duration assets. In 2007, liquidity imbalances revealed hidden vulnerabilities beneath seemingly stable balance sheets. And in 2023, several U.S. regional banks collapsed after sudden digital withdrawals. The world learned that in the age of instantaneous transfers, DOS, deposit flight no longer requires panic, only preference. The difference now is scale. Analysts note that trillions moving to money markets is unprecedented. Even in previous high-rate cycles, the migration was slower and smaller. Now, entire segments of deposit holders, wealthy individuals, corporations, institutional clients, are shifting capital with minimal friction. Here's the trap. Banks have long operated on the assumption that deposits are sticky, that customers keep money in low-yield accounts despite better alternatives. That assumption is breaking, and once it breaks, it may not return. In the modern financial landscape, stickiness is dead. Speed is king. And this raises the crucial question: what happens if the silent outflow accelerates faster than banks can adjust? Analysts outline 3 scenarios, none guaranteed, all conditional, but each shaped by the same underlying forces now reshaping the system. Scenario 1. The soft landing. In this outcome, central banks stabilize interest rates. Depositors settle into a new equilibrium. Banks adjust funding strategies, diversify liquidity sources, and reduce risk exposure. Credit tightens, but not severely. Growth slows, but does not collapse. According to some economists, this scenario is plausible if inflation continues cooling and rate pressures ease. The silent run slows, and banks adapt to a smaller deposit base without breaking. But this scenario depends on something uncertain: time. Banks need time to adjust balance sheets and reposition assets. If rates stay high too long, the pressure mounts. Scenario 2. The grinding squeeze. This is the scenario several analysts argue may already be unfolding. Deposits continue drifting toward higher-yield instruments. Banks compete by raising deposit rates, reducing profit margins, and cutting lending activity. The credit supply shrinks. Small businesses struggle for financing. Commercial real estate, already strained, faces refinancing pressure. Consumers experience tighter approval standards. This slow contraction does not look dramatic. It looks like stagnation, reduced activity, lower investment. a creeping economic weight that is hard to see but easy to feel. Everyone thought banks would simply adjust. They didn't. The danger wasn't explosive collapse, it was erosion. Scenario 3. The liquidity shock. This is the darkest possibility, not guaranteed, but discussed by analysts studying systemic risk. In this scenario, a trigger, an earnings miss, a failed bond sale, a regional crisis, causes a sudden surge in deposit withdrawals. Not panic-driven, but safety-driven. Depositors move funds into Treasury-backed vehicles or major institutions. The outflow drains weaker banks rapidly. Liquidity backstops activate. Emergency measures are deployed. Markets wobble. The shock is not caused by fear. It is caused by rational preference under stress. If this scenario unfolds, the silent bank run becomes visible. It becomes news. It becomes a moment that exposes the fragility beneath the system's calm surface. But whether mild or severe, the deeper question remains: who loses and who adapts? Those who lose include institutions most dependent on local deposits, small businesses reliant on consistent credit, and households living financially close to the edge. These groups experience the tightening first and feel it longest. Those who adapt include money market funds, Treasury-backed instruments, and large financial institutions that benefit from deposit inflows during uncertainty. Investors positioned in short-term government securities may see stability even as banks experience strain. But the most profound shift isn't financial. It's structural. A world where trillions move freely outside the banking system is a world where the traditional model of banking changes. Analysts suggest that one scenario indicates the future could see diminished reliance on deposits as the primary funding source. Banks may evolve toward models that rely more heavily on wholesale markets, securitization, das Erd, or partnerships with institutional investors. This evolution could fundamentally reshape the financial landscape. Some describe it as modernization. Others describe it as vulnerability. Here's what nobody tells you. Every financial transformation begins quietly. The migration looks harmless until its cumulative impact becomes unavoidable. And by then, the system has already changed. As we approach the final part of this story, the real question surfaces, one that determines the shape of the next decade. Is this silent bank run a temporary rotation born from high interest rates, or is it the early stage of a much larger structural shift in global finance? No one can say with certainty. Modern crises demand conditional thinking. Analysts offer frameworks, not predictions. Yet all frameworks point to the same truth. Liquidity is leaving traditional banks, and the system built on those deposits must now evolve. Some scenarios end in equilibrium. Others end in tension. A few end in shock. But every scenario begins with the same simple movement. Trillions leaving. Quietly, invisibly, rationally. And the future will be shaped not by what the system looks like today, but by what it becomes when the outflow finally stops.